Today, I am breaking down both sides. The bulls, the bears. And by the end, you will have everything you need to make your own decision. But first, let me show you what the smart money is actually doing. Welcome to Alpha Markets, where we decode the market and build your wealth. According to SEC filings, Berkshire Hathaway just registered the potential resale of roughly 325.4 million Kraft Heinz shares. That is about 27.5% of the company. Data shows the stake is worth around $7.7 billion near recent prices. The market heard that, and it reacted fast. Kraft Heinz is a packaged food giant built on household staples. Think ketchup, mac and cheese, sliced meats, and shelf-stable grocery items. It sells through grocery stores, club stores, mass retailers, and food service channels. The business is not glamorous, but it is everywhere. The core idea is simple. Own brands that win shelf space, then monetize repeat purchases at scale. When that works, the company earns strong cash flow, funds marketing, and refreshes products. When it fails, volumes slip, pricing power fades, and the fixed cost base starts to bite. Market position is still meaningful in North America. Heinz ketchup remains a category anchor. Kraft has deep distribution and brand recognition. Oscar Mayer is still a familiar name in refrigerated meats. Those are real assets, even if the growth has been disappointing. But the industry has shifted. Consumers want cleaner labels, higher protein, and more fresh options. Private label has improved, and price-sensitive shoppers trade down quickly. That pressure is not unique to Kraft Heinz, yet the company has felt it harder than many peers. Now let us unpack the business model. Kraft Heinz makes money by selling packaged foods at a markup over ingredient and manufacturing costs. The key levers are volume, pricing, mix, and efficiency. If volumes fall, management typically tries to raise prices or cut costs. That can protect margins in the short run, but it can also weaken brands over time. Revenue is spread across sauces and condiments, cheese and dairy, meats and convenient meals. There is also an international footprint, but North America drives the story. Competitive advantages come from distribution scale, retailer relationships, and brand equity built over decades. Bulls argue those advantages are being underestimated because the company is about to restructure. The plan is to split into two entities. Global Taste Elevation Co. would focus on sauces and spreads. North American Grocery Co. would hold the grocery staples. The expected close is in the second half of 2026. But here is where things get interesting. Recent performance shows why the market is so emotional. On January 21st, 2026, shares fell 5.72% and closed around $22.42 near 52-week lows. The stock also traded as low as about $21.99 intraday after the Berkshire filing news. After-hours trading showed another decline after the prospectus supplement. Trading volume surged by over 115%, putting the name among the most active stocks that day. The numbers tell a different story beneath the chart. Net margin is negative 17.35%. Trailing 12-month net loss per share is about $3.73. And the Altman Z-score is around 0.42. which signals distress. Historically, that has meant investors demand proof of stabilization, not just promises. Now we can lay out the bull case. Bulls argue the split can unlock value by creating focus. A sauces and spreads business could be valued like a steadier branded condiments company. A grocery staples business could run with a different cost structure and capital plan. Separate boards and incentives can also change behavior. Bulls also point to leadership. Steve Cahillane became CEO effective January 1st, 2026. He is known for restructuring experience, including the Kellogg split in 2023. Supporters believe he can simplify operations, sharpen innovation priorities, and rebuild accountability. Another bullish angle is liquidity and ownership change. If Berkshire sells stock over time, the shareholder base could rotate. Bulls counter that new institutional investors may step in if the valuation looks distressed and the restructuring plan gains credibility. A clearer post-split story can attract different types of funds. Bulls further argue the brands still matter. Dominant retail presence provides a stable revenue base, even in slow-growth categories. If management reinvests in marketing and product quality, it can defend shelf space. In packaged food, small improvements in distribution and mix can have outsized effects on profits. Finally, bulls see optionality in innovation. Plant-based lines, higher protein meals, and better-for-you condiments could reignite consumer interest. Even modest success can lift margins if it supports premium pricing. Rachel Wolf at eMarketer said the sale is unlikely to affect the breakup, and it underscores the need for a strategic overhaul to get the brands back on track. Drop a comment. Do you think breakups actually create value, or do they just hide problems? I read every comment. And that is when the market revealed the truth. Now we have to take the Bear case just as seriously. Bears counter that Berkshire selling is not just a technical event. It is a signal from the architect of the 2015 merger. Warren Buffett has expressed disappointment in the split strategy, and the filing came right as Greg Abel became Berkshire CEO on January 1, 2026. Bears read that as waning confidence at the top. Bears would argue the track record is already the verdict. Berkshire took a $3 billion write-down in 2019 and another $3.76 billion write-down in 2025. The cumulative loss since the merger is about $8.4 billion. That is not a small mistake. It suggests deep strategic failure and poor capital allocation. The financial metrics reinforce the concern. Negative 17.35% net margin is not a normal packaged food outcome. A $3.73 loss per share over the last year shows profitability is still not fixed. Bears would argue that if brand strength were truly intact, results would look better even in a tough environment. Then there is the distress signal. An Altman Z-score near 0.42 places the company in the distress zone. The risk here is not just volatility. It is the possibility of tighter credit, higher refinancing costs, and reduced flexibility to invest in innovation. Bears also question the split itself. Complexity can create disruption, one-time costs, and execution risk. Analysts worry separation does not solve declining demand for traditional branded packaged goods. Private label keeps improving, and healthier alternatives keep taking share. Spinning pieces does not automatically rebuild consumer love. Jeffries at Jeffries warned that focus on the split and the CEO transition could divert attention from critical growth initiatives, such as brand innovation and cost optimization. Russ Mould at AJ Bell said, Greg Abel has decided to cut his losses and close the position. Bears also flagged the overhang. A massive block of shares entering the market can pressure the stock for a long time. If this analysis is helping you, hit that like button. It helps more people find this content. As always, this is educational content, not a recommendation to buy or sell anything. And this is where it gets really interesting. Let us talk valuation without pretending precision. At around $22 per share, the market is pricing in skepticism. Traditional PE ratio analysis is less useful with losses. Investors often look at enterprise value to sales, free cash flow potential, and peer multiples. If margins normalize, the stock can look cheap. If losses persist, it can look like a value trap. A fair framework is scenario-based. In a bull scenario, the split executes cleanly, brands stabilize, and margins recover. In a bear scenario, volumes keep sliding, costs rise, and the split adds disruption. The market will likely trade on evidence, like improving organic sales, better price mix, and credible guidance. Now compare competitors. Peers in packaged food with stronger innovation pipelines and steadier margins often get higher multiples. Companies with cleaner balance sheets also get more benefit of the doubt. Kraft Heinz has scale, but it lacks recent proof of brand momentum. Relative valuation may look tempting, yet the risk premium is higher. But there is one more thing you need to understand. Risk factors are not abstract here. Insolvency risk is implied by the distress score, even if it is not a base case. Execution risk on the split is high. Market share losses to private label and healthier brands can continue. Debt and cash constraints can limit marketing and product investment. And the Berkshire overhang can keep sentiment weak. And this changes everything for investors. So what is the balanced verdict? This is a troubled turnaround with real assets and real problems. Investors might consider it if they are comfortable with restructuring uncertainty and can track operational progress. More conservative investors may avoid it until margins improve and the split shows concrete benefits. My take is that the next year is about proof, not stories, and both outcomes remain plausible. The Kraft Heinz saga shows us that even legendary sponsors can be wrong when fundamentals and consumer tastes shift. Share this with someone who needs to understand why breakups and big shareholders do not guarantee returns. Drop a comment. Are you bullish or bearish on the Kraft Heinz turnaround? I read every comment. Hit like if this analysis helped and subscribe to Alpha Markets for weekly market breakdowns. Next week, we break down another iconic consumer brand under pressure and why it matters for your portfolio.